Marcus was 28, working as a software developer in Austin and putting money into his 401k every month. He felt good about that. But when a coworker asked him one simple question, "How is your money actually allocated?" Marcus had no answer. He had no idea that all his money was sitting in a single target fund that wasn't right for his age. Over the next 12 months, he made one adjustment that could be worth hundreds of thousands of dollars by the time he retires. Today, we're going to break down exactly what he learned. Asset allocation by age. So let's start with the basics. Asset allocation simply means how you divide your investment money across different types of assets, mainly stocks, bonds, and cash. Stocks tend to offer higher long-term growth, but come with more volatility. Bonds are more stable but typically grow more slowly. The key insight is this: the right mix isn't the same for everyone. It depends heavily on your age, your timeline, and your risk tolerance. Marcus had been treating his investments like a set-it-and-forget-it situation. And that's a common mistake. Getting the allocation right is arguably more important than which specific funds you pick. Here's the core logic behind age-based allocation. When you're young, you have time on your side. If the market drops 40% when you're 27, like it did in 2008, you have decades for it to recover. But if that same crash happens when you're 63 and 2 years from retirement, that's devastating. This is exactly what Marcus realized when he looked at his parents' portfolio during the 2020 COVID crash. His dad, who was 61 at the time, hadn't adjusted his allocation away from stocks. He lost nearly a third of his retirement savings in weeks. The lesson: your portfolio should grow more conservative as you approach the finish line. This chart shows a widely referenced guideline for stock versus bond allocation across different age groups. Notice how the stock percentage decreases as age increases, while bonds take up more of the portfolio. In your 20s, many financial educators suggest something close to 90% stocks and 10% bonds. By your 60s, that might flip closer to 40% stocks and 60% bonds. This is the framework Marcus started applying once he understood it. These aren't rigid rules, they're starting points. Your specific risk tolerance and goals matter too. But the general principle, shift towards safety over time, is backed by decades of financial research. Now, you might be thinking, how do I remember all this? Here's a shortcut that Marcus uses. It's called the Rule of 110. You simply subtract your age from 110, and that gives you a rough target for how much of your portfolio should be in stocks. So at age 28, like Marcus, you're looking at around 82% stocks. At 55, closer to 55%. Some older versions of this rule used 100, but given that people are living longer and need their money to stretch further, many financial educators have updated it to 110 or even 120. This is for educational purposes only. Your individual situation may vary, but it's a clean, memorable starting point. This is the chart that really drove it home for Marcus. It shows two hypothetical $10,000 investments over 30 years. One portfolio is aggressive, 90% stocks, 10% bonds, historically averaging around 9% annual returns. The other is conservative, 40% stocks, 60% bonds, averaging closer to 5.5%. After 30 years, the aggressive portfolio grows to roughly $132,000. The conservative one lands near $49,000. That's a difference of over $83,000 from the same starting amount. Now, this is the critical part. The aggressive strategy also drops harder in bad years. Past performance doesn't guarantee future results, and both strategies carry risk. But for a 28-year-old, the data suggests time is a powerful ally. Over $82,000. That's the potential difference between an age-appropriate aggressive allocation and a premature conservative one. Starting with just $10,000. And remember, most Americans aren't investing just once. They're contributing monthly through their 401k or IRA. When you multiply that across decades of contributions, the gap becomes enormous. Marcus did this math and realized that the mismatch in his portfolio wasn't just a minor detail, it was a six-figure decision hiding in plain sight. The good news? He caught it at 28. There's still plenty of time, and so do you. So, how do you actually make this happen? Step 1. Log into your 401k or brokerage and find your current allocation. Most platforms show a simple pie chart. Step 2. Compare it to your age-based target. If you're 30 and you're at 60% stocks, that may be too conservative. Step 3. Consider target date funds. These automatically adjust your allocation as you age. Marcus moved a portion into a target date 2055 fund, which matched his expected retirement year. And step 4. Rebalance at least once a year. Markets drift, and your allocation will shift over time as different assets outperform. A quick annual check keeps you on track. Now, stocks and bonds aren't the only options. A well-diversified portfolio might also include REITs, real estate investment trusts, which let you invest in real estate without buying property. International funds expose you to global markets beyond just the US, and keeping some cash or money market funds covers short-term needs without forcing you to sell investments at a bad time. Marcus added a small international index fund after learning that the US represents roughly 60% of global market cap, meaning almost half the world's investment opportunity is outside our borders. But here's a word of caution. Complexity isn't the same as quality. A simple 3-fund portfolio has outperformed many complicated strategies historically. Here's why staying invested in equities when you're young makes sense. This is the S&P 500, an index of 500 large U.S. companies over the past 10 years. Despite major turbulence in 2020 and 2022, the long-term trend is unmistakably upward. According to historical data, the S&P 500 has returned approximately 10% annually on average over the long run, before inflation. That's the growth engine that drives the aggressive portion of a young investor's portfolio. Marcus didn't need to pick winning stocks. He just needed to stay invested in low-cost index funds that track this market. Time in the market, not timing the market, is what the data consistently supports. Marcus is now 29. After one conversation with his coworker and a few hours of research, he rebalanced his 401k to roughly 85% stocks and 15% bonds, appropriate for his age and a 30-plus year runway to retirement. He also set a calendar reminder to review his allocation every January. He didn't need a financial advisor, a complex strategy, or a hot stock tip. He just needed the right framework. And now you have it too. Asset allocation by age isn't glamorous, but it might be the single most impactful portfolio decision you make. Start where you are, adjust as you grow, and let time do the heavy lifting. Everything in this video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial professional before making any investment decisions. All investments carry